Hey traders, Money Badger here again, and I'd like to welcome you back to Badger Trading University. If you haven't already joined the BTU Discord, click the link in the video description below. In our previous video, we developed a solid understanding of moving averages, with a focus on two of the most popular, the simple moving average and the exponential moving average. We also discussed how to use a single moving average to identify buy and sell signals, as candlesticks closed either above or below a moving average, so be sure to check that video out as well. In this video, however, we will discuss how we can apply what we've learned previously in order to produce additional buy and sell signals using the moving average crossover strategy. When using the moving average crossover strategy, two moving averages are applied to a chart, one short-term and one long-term. Traders can apply any type of moving average, like the simple moving average or the exponential moving average, depending on personal preference. Traders should then apply a period length to each moving average that effectively aligns with their trading style. Remember, a period refers to how many candlesticks are used to calculate the moving average. A 9-period moving average uses the price data from the most recent 9 candlesticks' closing prices, while a 21-period moving average uses the price data from the most recent 21 candlesticks' closing prices, as seen on the chart here. While it's true that a trader can use any period, sticking to the most common that many other traders are also using to support their trading decisions often leads to better results. Some traders see this as sort of a self-fulfilling prophecy, as many traders base their trading decisions on these periods. The most commonly used moving average periods include the 9, 21, 50, 100, and 200. And to give you a better idea, a day trader typically uses shorter periods such as the 9 and 21 period, whereas a swing and position trader would use longer periods, such as the 50, 100, and 200 period. In the chart shown here, we have applied two simple moving averages, or SMAs, the 9 period and the 21 period. Let's take a look at how we can effectively use the moving average crossover strategy. The basic principle behind the strategy is simple. When the short-term or 9-period SMA crosses above the long-term or 21-period SMA, it produces a buy signal and is referred to as a golden cross. Conversely, when the short-term 9-period SMA crosses below the long-term 21-period SMA, it produces a sell signal and is referred to as a death cross. While this seems pretty straightforward, there are a few things to keep in mind. Moving averages in general are not considered very useful in a ranging market. As you can see here, the moving averages remain mostly center of the price action, producing several buy and sell signals. If you were to enter and exit trades based on these signals, you would have experienced a loss. Strategies involving moving averages should be utilized in a trending market to help avoid whipsawing and false signals. As seen here, a buy signal was produced when the 9-period SMA crossed above the 21-period SMA, and since the market was trending, it would have allowed a trader to remain in their position longer, earning higher gains until the sell signal was produced once the 9-period SMA crossed back below the 21-period SMA. As with most technical indicators, moving averages should not be used alone when making trading decisions. I always encourage traders to trade with confluence and stack elevating factors across multiple indicators, chart patterns, and candlestick patterns, which will help identify higher probability trades and avoid entering into losing positions. Thank you so much for watching. If you enjoyed the video and maybe even learned something new, please like, subscribe, and join our Discord by clicking the link in the video description below.